Hello everybody, welcome to today's DFT Lesson 9. Today we will be understanding banking and financial services, which is super important for managing your money and achieving financial stability. But for many people, navigating the banking system can feel like trying to solve a mystery. So let's dive right in. Let's talk about the different types of bank accounts first. Each one serves a different purpose, so it's important to know which one is right for you. The first bank account is checking account. A checking account is your everyday transaction. Think of them as your financial hub for paying bills, buying groceries, and withdrawing cash. So, the features over here we have check writing abilities, which are writing paper checks and then you can send them off. You have debit card for ATM withdrawals and purchases. What do you mean by withdrawal is so as you go to an ATM machine, you will insert your card, type a PIN, etc. Choose the amount of money you want to remove from your bank account. And so therefore, you'll be withdrawing money out of your bank account. So you also have monthly fees, but you can try to avoid them by maintaining a minimum balance or setting up direct deposits. Deposits is technically just putting money into your bank account. So withdrawing is removing it, depositing is putting it back. So usually you do not earn interest rate on checking accounts, but there are bank accounts where you will earn interest rate. Interest rate is just extra money you will be either paying for, like in loans, you'll be paying interest rate, but in some bank accounts, like the savings accounts, you will be earning interest rate, which means you will be earning money for doing something. So for example, Maria uses her checking account to pay her rent, utilities, and grocery bills. Her paycheck goes directly into this account. Now let's look at savings accounts. Savings accounts are where you stash your cash for future goals. They help you save over time. So the features are that you will earn interest rate on your balance. That means it's the extra money you will earn for keeping your money inside the bank account. Limit on the number of withdrawals per month. Obviously it's a savings account, so your idea is to put money in there so you could save for your future goals. And the third one is usually lower fees compared to checking accounts. You'll be paying less compared to checking accounts. So for example, John saves $50 from his paycheck every month for a family vacation. So he takes $50, puts it into savings account, and keeps it there for his future goals, which is for a family vacation. Number 3 is money market accounts. These are accounts that combine the best of checking and savings accounts. So this is a mixed feature one. Therefore, you have high interest rates than regular savings account. So you will be earning more money on money market accounts. You will be allowed to do check writing, but it's limited. And there's also debit card use. Also, it requires a higher minimum balance. That means you will have to start with a higher amount of money in the beginning. So Sarah uses a money market account to save for a house down payment. She enjoys the higher interest rate and can write a few checks when needed. This means that she starts with a higher balance. Therefore, she starts with, let's say, for example, $1,000, and she puts it into a money market account, and she saves that money, and she puts money every month and saves it to repay her house down payment. So number 4 is your certificates of deposits. Now CDs are very good for saving money for a set period, earning a guaranteed interest rate. So this is a fixed term savings. Therefore, it has higher interest rate than savings account. You have your money locked for a specific period of time. This means that I can only have it for a specific time period. So if I said 1 year, I can only have it for 1 year. I can't take it before, I can't do it after. It has to be 1 year only. So for example, David buys a 1-year CD to earn a high interest rate, knowing he won't need that money for a year. So David knows that he does not need that money that year, so he can put it in a CD account and earn interest rate from that. Number 5 is IRA, which are your individual retirement accounts. Now these are for your long-term retirement savings. Therefore, you will have some tax advantages. You will have a traditional IRA and Roth IRA options, annual contribution limits, and early withdrawal penalties as well. So you will have a limit to how much money you can put into that account, and you can't you should not withdraw money before the time period. So Emma opens a Roth IRA and saves $100 a month for retirement. Her withdrawals in retirement will be tax free. That means when she withdraws all that money out, it will be without taxes. So how do you choose the right bank account? Well, your first thing is to identify your needs. Determine your needs: daily transactions, saving interest rate, or long-term savings. If you need an account for everyday expenses, a checking account is best. For long-term savings, consider savings account or CD. Number 2 is considering bank fees. Look at monthly maintenance, ATM fees, overdraft fees, minimum balance requirements. You will look for a checking account with no monthly fees if you set up direct deposit, which means your money will directly pay back. So you're directly putting the money back. Number 3 is interest rates. Especially for savings account, money market accounts, and CDs, you want to have a higher interest rate one. For number 4, you want accessibility and convenience. So you want to choose a bank with a convenient access. So you can go to an ATM. If you find the ATM next to you, you can easily use an ATM machine, or the bank is very reputable, or it has great customer service. So 5 talks about customer service, which is for review their banks. Is it high customer service, low customer service? And so if you encounter any issues, you will face no problems. And then look for a bank which has additional services such as financial planning, loans, credit cards, investment options. So the banks will help you with those additional services you might need. So let's understand bank fees. So there are monthly maintenance fees, which are often waived with direct deposit or minimum balance. There are ATM fees, which is using out-of-network ATMs that can be costly. Now, these are like ATMs which are not part of that specific bank. You might be using it like another bank, so therefore you might have ATM fees. You have overdraft fees, which are fees for spending more than you have. You can't spend. So for example, Rachel signs up for an overdraft protection. Therefore, she links her savings to her checking account. So therefore, if she were to spend more than you have, her savings account will cover that up. Then you have transaction fees, which are fees for wire transfers or excessive withdrawals. And then you have inactivity fees. I mean, you want to have a bank account because you're using it. If you do not use it, well, then you might have to pay. So then there are understanding interest rates. You have saving interest rates, which are higher rates to help your money grow faster. You have loan interest rates, which are lower rates that save you money over time. So then you have compound interest, which is interest on interest, which helps your money grow even faster. So let's look at examples for each one. Saving interest rates. So Emily moves her savings to a high yield account to earn more interest rate. Therefore, she'll be earning more interest on her savings account. So she changes her account. Second is a loan interest rate, which, for example, Mark shops for the best car loan rate to keep his payment low. So what you do is when you are looking for a loan, you want to look for the lowest interest rate. But when you're looking at a savings account, you want higher interest rate. This is because when you borrow money, banks and other financial services will require you to pay that money back plus extra interest rate. So you want to choose the lowest as possible. And then you have compound interest. So Laura chooses an account that compounds interest daily to earn money over time. Therefore, you will be multiplying it. So there's a specific multiplier, and you will, for example, if interest rate at the beginning of month 1 is A, then interest rate 2 will just be A times A. But you will be adding it on. So it's just going to keep increasing. Then you have opening a banking account. So you want to have required documents. You want to visit the bank or apply online. Also, you want to complete all the forms and documents. You want to make an initial deposit to make sure that you have met that requirement, and you want to set up account features such as direct deposit, online banking, and automatic transfers. So these are the steps you have to do for opening a bank account. but make sure that you have reviewed that this is the bank account you want to commit to. Next is managing it. Now, managing is monitoring your account regularly. Check for balance and transactions. Avoid spending more. You want to check. For example, even if you make a very simple budget plan using a template, you will then be able to have an idea of your spending. You want to set up alerts. So for example, if you have low balance, then you will get a transaction alert. Therefore, you know that you should not buy anything else to avoid overdraft. Use direct deposit. If you use direct deposit, it will automatically cover all the costs and everything. Then you have automate savings. You want to set up regular transfers to your savings account. On your bank account, you can link that checking and savings account. Therefore, whatever you earn directly just goes to your savings account. So now we'll be concluding our topic. So understanding banking and financial services is essential for managing your money and achieving financial stability. By choosing the right banking account, monitoring your account regularly, and taking advantage, you can make the most of your financial resources. Stay informed, make smart choices, and happy banking. Thank you.